The S&P 500 on an average year will rise by 10%, but over 2022 it fell by almost 20%, and thanks to inflation, the real return was closer to negative 30%. The average return above inflation for a US 10-year Treasury yield is usually 1 to 2%, but over 2022 it was negative 7%. Real estate typically appreciates by 2 to 3% a year across the United States, but recently it's been falling at an annualized rate of negative 10%. Everywhere we look right now, investing is going in the wrong direction and people are losing money, but there's this distinct sense of optimism surrounding us, of people sure that things will end up alright because they always have done in the past. But I'm afraid I'm here to pop that bubble just like the Fed popped the everything bubble. There is a distinct possibility that things are not going to get better, that stocks will continue to fall, that bonds will continue to underperform, and that housing will continue to crash not just for months into the future but years. This is called the lost decade, and we've already seen it before in history, but that doesn't make it any less terrifying. The truth is that our economies are on the brink, that things are not going well, and that the next 10 years may see things get worse, not better. Now, if you're interested in ways to diversify your portfolio while 90% of asset classes are falling, then keep an eye out for this video's sponsor, Masterworks. Now, before we get into the nitty-gritty and establish exactly what the lost decade is, what it might look like, and examples of them in the past, we need to first establish why I think it's so likely, and this all comes down to our banking systems and the fundamental threat posed to our economies by the ridiculous levels of debt looming over our countries. When it comes to debt bubbles, there are two screaming issues that simply can't be ignored, and I've already covered them in previous videos, but they're so vital to the future that they are seriously worth briefly going over again. The Bank for International Settlements is a name you probably haven't heard of, but you should have, as it's an international financial institution that can be only described as a behemoth that is literally owned by 63 separate central banks from around the world. It's the central bank to central banks, and not just Western ones either. The Federal Reserve, the European Central Bank, the Russian Central Bank, and even the People's Bank of China. You name a central bank and it probably has its tentacles wrapped up in the ownership of the BIS, as together these central banks control 95% of the GDP of the entire world. Why am I talking about them then? Well, because they recently put out a report that highlighted a $97 trillion debt bubble that is being hidden from the public eye, as our laws don't require companies to report it on their balance sheets. But maybe you don't want to take my word as gospel, fair enough. Literally the second sentence on the summary of this report says that there are foreign exchange swap positions that point to over $80 trillion of hidden US dollar debt reported off balance sheets. And when you take into account the hidden debt denominated in currencies other than the dollar, that 80 trillion rises to $97 trillion, and that's pretty much the size of the entire global economy. So I'm really not being hyperbolic here when I say this is a disaster waiting to happen. Now, the nature of this debt is a little bit unusual, but we covered it in great detail with a previous video on our channel linked down below, and we don't really need to delve back into it today. All we need to know is that this is real debt, it is monstrous, and as interest rates rise, as they have been doing over the last year, this debt burden gets even larger. Just a 1% increase in interest rates represents increased borrowing costs of $1 trillion a year, and the Federal Reserve has so far hiked interest rates by 5%, representing an additional burden of $5 trillion each year. But that is only one of the problems, and as I mentioned earlier, there's another one too, which is eerily similar to the subprime mortgage crisis that tore the global economy apart in 2008, only it's focused on a sector other than housing. There's a growing crisis in the auto loan market all across America, and once again it stems from greedy bankers. We all know that the car market was in a bubble and prices have been falling for months now, but what most people don't know is that while these prices fall, the total amount of auto loan debt is exploding for one very sinister reason. People are already underwater on their car loans, which means the debt is worth more than the vehicle, and that means when people go to sell their cars, they'll still have a loan afterwards. Usually, this would stop any bank in the world from giving someone a second car loan to buy a new vehicle, but not anymore. This tweet thread from the owner of a 9-car dealership has exposed how 9 of their banking partners have stopped caring about old loans and are giving out new ones anyway. This car price bubble collapse means that people can't buy new cars, dealers can't sell new cars, and banks can't finance them, which means the entire industry is losing out, and the solution is just to throw more debt at it, according to banks. Of course, this is happening as interest rates are continuing to rise, and every week another 20,000 layoffs are announced, which means the only way for this new crisis to resolve is everyone who is ridiculously underwater in their debt to sell their vehicles and declare bankruptcy, which will leave the banks holding the bags, just like we saw in 2008. Now, I personally can't think of a better way to describe a loan to someone who has already proven they can't pay off their loans than as subprime, and that's why this is a brand new subprime loan crisis growing right in front of our eyes. Finally then, we have the ridiculous mountain of credit card debt that has been built up over decades but is not being paid off, and just like other debt bubbles, rising interest rates makes this even more of a problem and pushes us even closer to the point of collapse. Now, there have been many financial crises, but 2023 is shaping up to be a year of lost wealth as every day the economy goes from bad to worse. Take this survey that revealed more than half of Americans who make six figures are now living paycheck to paycheck. Even college-educated young people with high-paying jobs are struggling to do basic things like pay for their rent and car payments. Then there's the tens of thousands laid off in recent weeks, and a clear financial storm is brewing and no one is safe. It's pretty hard to feel secure in your job when Powell is actively trying to bring the labor market to a screeching halt. At least Goldman Sachs, though, are being honest with clients about where they think the market is headed: nowhere. But if you think hedge fund CEOs and financial titans are letting their money just sit in savings accounts, think again. They're pouring hundreds of millions into assets that aren't necessarily correlated to the stock market, so if stocks stagnate as they expect, these assets can continue to grow. But how can we invest in some low correlation assets? Well, according to this report by Citibank, the asset with the lowest correlation to the stock market was contemporary art. That's right, art prices have more than doubled the S&P 500's return over the last 26 years. Now, this market used to be hard to get into, but Masterworks is the platform that lets you invest in multi-million-dollar paintings without breaking the bank. Masterworks has built an impressive track record of 11 exits, all of them profitable. These numbers speak for themselves, but with those kind of results, Masterworks has seen over 650,000 members try to gain access, so there is a waitlist. But I reached out to them to give you all VIP access to their latest offerings. To skip the waitlist, just check the description down below. Now, at this point, many people will be thinking to themselves that they understand why the markets are in so much trouble, but what exactly is a lost decade and what does it mean for us? Well, the basic definition is it's just a period of time, usually a decade or longer, where stocks don't go up like we're told they should. Usually this coincides with a market crash at some point, some kind of financial crisis, political strife, and a stagnant economy as well, but those aren't always the case. These lost decades, though, happen all over the world as well, and sometimes across the entire world too. Japan's lost decade has become infamous because they never really ended. They saw a massive speculative bubble that peaked in 1989, and it's now been 34 years, and the country has still yet to recover, leading these last 3 decades to be coined Japan's lost decades. This is the Nikkei 225 index, and you can quite clearly see that things haven't been stellar, and the country's economy hasn't really grown much for those decades either. But Japan isn't the only country to have seen a lost decade, with the United States seeing multiple over its time. The most recent one was the 2000s, which saw 2 speculative bubbles crash, causing the S&P 500 to barely provide any positive returns at all. But the economy did grow during the period, so many thought this wasn't a real lost decade, as seen in this Forbes article from 2010. When we talk about America and a lost decade, though, everyone instantly thinks back to the 1970s and 80s, where inflation soared high and stayed there, and the economy failed to grow. There were wars disrupting global supply chains, oil price spikes damaging corporate earnings, soaring inflation hurting people's incomes, and rising interest rates making debt more expensive, and these issues all played off each other throughout the 70s and 80s. Meaning that the S&P 500 didn't actually gain any value over those 2 decades when inflation is taken into account. In essence, a lost decade is terrifying to any investor because it represents the loss of the one resource we can't create more of: time. If you were planning on steady S&P 500 returns to retire by the age of 60, a lost decade will cost you 10 years of your life. So the question on everyone's minds is simple. Are we on the brink of another lost decade? And sadly, I can't actually see the future, but in my humble opinion, the answer is probably yes, and for a number of reasons. The ridiculous levels of debt we have right now, the fact that creating more debt is getting less and less effective at stimulating our economies, and the fact that inflation is high and it's going to stay high. Now, debt is something that you've no doubt heard about in abundance in recent years and how there's a lot of it and it isn't slowing down, but the really important thing people aren't looking at is how debt is the reason our economies have grown over the last few decades. Despite what you might think, Uber isn't actually a revolutionary business model that's putting taxi drivers out of business, it's just debt. DoorDash isn't a revolutionary system for cheapening costs when getting food to your door, it's just debt. And the vast majority of the wealth we saw build up over the everything bubble was just plain and simply fueled by debt, not some fundamental explosion in productivity or innovation. Debt is what's caused the markets to go up and up and up, but debt's creation is now out of the window thanks to rising interest rates as it gets more and more expensive to service that debt, so we can't rely on the same system to generate returns for investors going forward, and that leads us onto the second fundamental problem. Quantitative easing or debt creation or just money printing gets less and less effective each time it's used. Coming out of the global financial crisis, quantitative easing was used by countless countries for the first time in history to get the economy moving again and out of a recession. The United States printed $3 trillion over the course of 7 years from 2008 to 2015 to pull us out of that hole, but over 2020 alone they printed another $3 trillion and they then printed a further $2 trillion across 2021 and 22. The Federal Reserve's balance sheet went from $1 trillion in 2008 to $4 trillion over the course of a decade, and then it went from 4 to 9 over the course of 2 years. And yet, the results were far from stellar. If the Fed and the US government want to use quantitative easing to get us out of the coming massive recession, they're going to need to spend in excess of $10 trillion to do so, and that leads us on to the fundamental problem leading us towards a lost decade. Inflation is sky high, and we're going to find ourselves trapped in a multi-year long inflation crisis as outlined by Michael Burry in my previous video, and that means interest rates and debt servicing costs are going to remain high. The US government is spending about $200 billion on debt servicing on a good year, and that's going to rise to maybe even $500 billion a year as the debt itself has increased and the cost of that debt has risen too. If the government is to then increase that debt level by a further $10 trillion, which is what it would take to get markets moving again, the cost of that debt is going to increase even further. The simple fact is that the government can't afford to throw debt at the problem again, and they're going to have to deleverage in order to actually be able to bring interest rates down at some point in the future. All of this means that we're probably in for 10 years of no new spending packages from the president to get people back into jobs, and that means no massive tax cuts to stimulate small businesses and get local economies moving again. That means a long sustained period of economic hardship where things just don't get any better. On top of all that, the last time we saw an inflation cycle so great it changed society, we also saw a lost decade, and it stands to reason that the same sort of thing is happening right now. History may not always repeat itself, but it does often rhyme, and it's sounding awfully familiar right now. US markets have been living on borrowed time for years now, and the chickens have finally come home to roost. The prospects for the future just don't look very bright, but there are a few ways we can try to position ourselves to continue to profit even if the lost decade emerges. By signing up for Stoic Markets, our 100% free newsletter, you can remain informed and aware of everything going on, or you can try investing in non-market correlated assets with Masterworks with the link down below in the description. If you just want to see exactly what Michael Burry is warning us about with the inflation cycle, then watch this video here.